We have William Lee, Chief Economist and Executive Director at the Milken Institute, who's joining us now. William, good to have you with us here on the program. This back and forth with the EU, William, how do you see it? Will it follow the typical thing we've seen, a very high rate threatened, a lower rate, which is then walked back to a lower rate, and then something in between, and the market cheers because it's not as bad as what markets thought it would be, but it is higher than what it was before? What is your sense, William?
Well, if you look at the pattern of negotiations that have gone on up until now, you found that the partners with the U.S., those are the countries that really want to partner with the U.S., invest in the U.S. and produce in the U.S., like the U.K., Japan, they were received in a very friendly way. Even when there are some complaints about the speed of the negotiations, how they are getting stalled, they really were making steady progress. And then you had competitors like China, and even there, China says, well, we produce stuff so well, we don't want to produce in the U.S., and we're going to import it into the U.S., and we're going to pay these tariff barriers. And even there, you find that the type of barriers they're going to be facing are really quite limited. The minimum 10% tariffs and the fentanyl tariffs, which is a very special case. But now we have the EU. And the EU, I think, came up with an initial offer of, oh, let's go 0-0 tariffs. And of course, that's a joke because the GATT rounds and the rounds of tariff reductions we've had over the decades have reduced tariffs to almost nothing. And the real obstacle to trading with the EU has always been the non-tariff barriers. And the Europeans are masters at coming up with all sorts of legal and bureaucratic ways of keeping people out of their market and protecting their domestic giants. Now, you notice the EU has no tech industry. The EU has no source of real technological innovation of the sort that we see in Asia and of the sort that we have seen in the United States. So in some ways, the EU is just expressing to us the fact that they just are not willing to adjust their regulatory structures and their bureaucratic structures in a way that would be compatible with the kind of innovative investments that we really need for the 21st century high-tech industries. So that tells you something about the nature of the EU market. And I think the negotiations with them will continue to be very, very difficult because they really are very resistant to the kind of progress that a lot of the Asian and American companies really want to see.
William, morning. Thanks for joining in. The other development, I wonder how you read that. This whole directive, and it's a straight diktat to a publicly traded company, right? I'm talking about Apple, saying you don't make here, you have to make here. I mean, this reminds us of the license Raj era back in India, back in the 70s, and we've come a long way from there. The Apple stock was down 3%. But could this snowball into something bigger, or do you think the market will just ignore it and move on?
I think it's going to be something like what happened with the U.S. Steel and Nippon Steel merger. Donald Trump said, look, you can merge with any other company you want, but come on, this is such an iconic company, U.S. Steel. They reached an agreement where they just have massive amounts of Japanese investments. There's a lot of co-ownership, but it's not called a merger. I think Apple is such an iconic symbol of the tech industry for the United States. There again, it's going to have to be a very special kind of a deal. I think that's not representative of the other tech industries and other tech companies like NVIDIA that's making deals left and right. And I think those are the more representative type of deals that you'll see in the marketplace that the Trump administration is favoring. And Apple really is going to be like Nippon Steel, U.S. Steel. It's going to have to be a special carve out where Tim Cook's going to have to show we're serious about producing in the United States, not just a couple of MacBooks. And he's going to have to come up with some way of demonstrating his seriousness about moving high-tech industries and high-tech jobs into the United States, which is really the message of this administration.
All right. Hi, William. Good morning. Good to see you, Ben. Let's focus on the emerging markets. And India is, the question that I want to pose to you. How do you see things panning out here as an equity market? Well, we've got a little bit more expensive than the last time we chatted. But what's the outlook from here on? India, the longer-term growth story, while China, well, that's a more of a tactical play. Your take?
The Indian partnership, I think, is going to be a very special one. I think the Trump administration and certainly the Vice President Vance has made it very clear that the United States wants to treat India in a very special way. India, in some ways, is one of the few countries that trades with everybody, right? You're trading with the Russians, you're trading with the Chinese, you're buying also oil and all sorts of materials from all over the place. But because India is such an important producer and such an important alternative to China, it will be treated very, very differently. And I think we'll see that progress. For other emerging markets, I have to remind you again of the Lucas paradox. Lucas paradox, the Nobel laureate of University of Chicago said, money flows from where capital is least abundant to where it's most abundant, because in the advanced economies where capital is most abundant, it's also where capital is used most productively. That's where the innovations are. That's where the highest returns are. So in many ways, there may be a lot of portfolio readjustments and people wanting to diversify into emerging markets, but on net, we still see a net capital flow into the advanced economies from emerging markets. And in a way, that's unfortunate, but also it allows the emerging markets to really specialize more in the kind of industries in which it has a comparative advantage, rather than trying to leapfrog into these very, very high-tech, capital-intensive industries. But India, as I said, I think it's going to be a very special case where I think India is going to be allowed to do everything. And I think most investors are investing in India, not just as an emerging market, but perhaps as the one emerging market that's going to leapfrog all the others.
Okay, well, we surely hope that happens, William. Thank you very much for your perspective. Appreciate your time and look forward to a longer chat next time around. Thank you for joining in.